Bruce Berkowitz, thank you so much for being here and for joining me today.
Well, you're quite welcome.
I know that financials for a long time were kind of your core area of expertise. And back after the financial crisis, you'd bought quite a few of them and made a bet on Wall Street recovering. Today, a lot of people are betting on the financials because they think that rates might go up. You know, I know you maybe haven't looked at them in close detail, but do you have a sense, broadly speaking, of how the financials are positioned here for a rising rate environment? Is that the right kind of investment call to be making?
The financial companies, insurers, banks should do very well in a rising rate environment. I mean, as the rates go up, there'll be a lag between what they pay for deposits and what they charge. Give them a little bit more breathing room and should allow them to get back to more normal margins. So the answer is yes. On the other hand, after the crisis, the financial companies are more and more regulated utilities now, really not much different than your electric company or your water company. And under such tight regulation, I think it's going to be harder for those companies to get back to their traditional margins and products in certain areas. So for the financial companies that are still trading deeply below any kind of tangible book value, they're probably reasonably good investment as long as they don't trip up on cross-selling or
right. And you notably bet on Wells Fargo in the 90s when people thought commercial real estate might bring them to their knees.
I was a huge investor in Wells Fargo in the late 80s, early 90s when everyone thought Wells was going to go bust because of the lack of occupancy in high rises and all the commercial buildings they had, which didn't make any sense. And it didn't make any sense this last time how people just got taken and carried away about what was going on at Bank of America.
But you're referring back to the financial crisis.
This is the recent financial crisis.
And you've sold out of your investments in Citigroup and Goldman and I think Morgan for the most part, but you still...
Our big investment was in AIG.
But you also still own shares of Bank of America.
Yes, with Bank of America.
Why is that? Why hang on to that investment here?
I liked what Brian Moynihan is doing. I mean, he was dealt a very tough hand where he was coming in. He had a lot of issues that needed to be fixed, but the key was the fixable issues. There was enough earnings power in the company. The franchise was intact. The customer base is intact, so that when we were buying it, we were basically buying it for less than the cash per share in the bank. So if Brian could fix the issues facing the bank, especially countrywide, and that was just, in my opinion, it was just a matter of time. It wasn't, many of my investments, it's not an if it's going to happen, but it's a when. And I can't tell when. And it has taken longer than I've expected for the financials to recover, but they've been tripping all over themselves. And they're being disintermediated by high-tech companies, and there's so many other companies they should have owned and should be doing now. And so it's tough, but there's still a big trust factor when you go to a bank, a financial institution, that you feel as if you're wronged, there are remedies. Whereas in some of the newer concepts, it's not so clear to me.
Yeah, you mentioned there were some things that they should have done or companies they should have purchased. What would be an example of that? Are you talking about companies like Square or
Square, PayPal? Yep. I mean, they should have owned all of that.
Is there still time? I mean, are they still attractive?
I mean, the banks still have a level of consumer trust. I mean, on the one hand, there's consumer outrage about what happened across the financial spectrum during the last crisis. But on the other hand, your best shot to get a fair deal will be through a traditional bank. And that bank should be an ecosystem that allows the bank to expand its products and to sort of do a better job of democratizing the whole process.
And then just to put a point on it, because I use Venmo all the time, which PayPal owns, and I know a lot of people do, should Bank of America buy PayPal? Would that make sense to kind of culminate what you're talking about?
Well, I don't know why Bank of America, in a way, is already a PayPal. Visa's a PayPal. MasterCard, American Express is a PayPal. Every major bank is already a PayPal. But they could have been out there. They could have been doing it, and they should. I mean, they're going to be, the banks are going to become much more like technology companies over time.
One more question about the core financials, if you will, and that is Wells Fargo. It's sold off, and people are wondering whether it's going to re-rate to a much lower price now because of this investigation into the cross-selling. Much like you saw value back in the day when they had questions surrounding the future of the franchise? Do you see value in
Well,
Wells
I saw
today?
more value this time in Bank of America, and this is why I was a big investor in Bank of America rather than Wells, because Wells did not get anywhere near as tarnished as the other banks, and they were able to keep a lot of their high-earning business. So I thought that at Wells, I thought harder for Wells to progress forward than it would be from Bank of America, given where their relative positions were at the time in which I made the investment. I mean, after all, at the end of the day, the investment equation is basically what you pay versus what you get, what you give versus what you get, and so price versus value. So, Wells Fargo, no one thought Wells Fargo was going out of business, where people thought Bank of America was a few days away from going out of business, and at one point Goldman, and so on. And that just is, it's not right. It wasn't right. They weren't going out of business. It wasn't right in the late 80s, early 90s about Wells Fargo. It clearly wasn't right about our large financial institutions today. This whole concept of mark-to-market and so on got everyone crazy, and then the overlay, the regulation, and then the government coming in and deciding who the winners were going to be and who the losers were going to be, and sort of made things more difficult than they needed to be, especially with an AIG or with a Fannie Mae or a Freddie Mac.
Right. And you're very much driven by reading through the accounting statements, reading through the filings, and I read that going back to 2006 and how Countrywide and some of these were trading at the time, looking through the financials was enough of a red flag for you to stay away from them. Similarly for AIG, you said before a lot of people came to this acknowledgement that it was going to repay the government, and it has, and you continue to hold that.
I remember I was called to the United States Treasury, and I was sitting at this long table with these people in the Treasury, and they said, we got to ask you a couple of questions. One is, why did you invest in AIG? Why are you the only institution in the country that has invested a large amount of money in AIG? And my answer was pretty simple. Because I've studied AIG for 30 years, it has a franchise, it has a great reputation, and especially outside of the United States, it never lost its reputation. And AIG was the great example at one point of, how global, how an American company can be a great global enterprise. And because of a couple of minor divisions, and the stars aligned in a very unlucky way for the company, which caused them a lot of grief. But their issue was never one of going out of business. It was just an issue of fixing a couple of problems. But people overreact each way. I mean, I'm going through this. But AIG ended up being a tremendous win for the taxpayers, for the company, for my shareholders, and we're going through that same process now with Fannie Mae and Freddie Mac.
And with AIG, has that story now played out? I mean, do you basically think those shares are fairly valued here, or do you expect there to be further upside?
A good part of AIG was Hank Greenberg. And then when the government took over AIG and installed the board of directors and dictated what needed to be done, a good chunk of the value left, but still AIG, very cheap. It's getting closer to fair value. And it's really a question of how they handle their sort of reserve developments and how they handle risk control. And the new guy at AIG is taking them in a different direction. So if he can pull it off, AIG is still a cheap investment.
And seeing some of these investments or avoiding others is one of the reasons Morningstar had called you one of the top managers of the decade in 2010.
I was a hero then.
You were a hero, and you have since hit a bit of a rough patch. What lessons have you drawn from the last couple of years in which you've seen outflows, you've seen a change in leadership at the firm, and you hold some very controversial positions?
Right. I wish I moved in the direction I'm moving in now faster.
Which is what direction?
Investing is best done when it's most business-like. And, my job as a value investor, it always has been, is to basically find the mispriced securities. And that normally means I'm looking at a company that is misunderstood and most likely hated. Right. I mean, I was buying AIG when there had to be security around the building because of the hate about AIG. Same thing with Bank of America, same thing with Wells Fargo years ago. And I was a big buyer of Freddie Mac in the late 80s, early 90s when people were worried about Philadelphia going bust, and that people were just going to hand their keys in, and the Freddie Mac was going to go bust, and it didn't make a lot of sense.
Are you suggesting that you drifted from that in the last couple of years? So you moved to Miami in 2006.
Right. No,
changed up some of the leadership.
I saw the financial crisis coming, and I sold all of my financial stocks that had any kind of leverage. When your relatives start calling you up and telling you they want to quit their productive job and become a real estate magnate, there are certain indicators you can't ignore, and that's when we switched to more defensive posture with defense companies, healthcare, and then after the restructuring of the financials, where they were forced to take money and their balance sheets were better than any time in their history, and their earnings power still quite sufficient. We went back in, of course, too soon. I could have stayed with the defense, healthcare, continued to go up.
Right.
Came in too soon, back to the financials. But I've always suffered from premature accumulation.
And just so people are aware, some of your top holdings today include, we've talked about AIG already, but Fannie and Freddie.
Right.
Sears and its real estate spinoff, and Land's End, which was also a spinoff. St.
Joe's,
which is it has become a somewhat controversial story simply because you and David Einhorn took two different sides of it. So it's much the case today, as you've said, as in the past, people would look at your holdings and say, are you crazy?
Right.
But does it reflect where you want to be with the firm and the funds today?
Yeah, it is where I want to be. I'm the chairman of St. Joe. I'm on the board of Sears. I appreciate being able to take a deep, hard look at the companies. I've spent a decade or more on some of these companies, and I want to make these investments very long term. And I think there's a chance that we will do extremely well in the positions. I mean, the case of Fannie and Freddie is a good example. Fannie and Freddie, the two companies, make about $12 to $15 billion a year. So it's kind of crazy that they're in a conservatorship.
But let me just before we get into
all right.
You're a free market kind of guy, right? I mean, so the idea that Fannie and Freddie should continue to exist would offend most people with your point of view. So it's interesting to hear you make the case that they should exist. It sounds, David Stockman, who's Reagan's former budget director, his point of view on this whole thing is, look, the right path here would be to privatize the housing industry, get rid of Fannie, Freddie, wind them down, let the assets run off.
I'm a preferred stockholder in Fannie Mae and Freddie Mac. So I have a contract with Fannie and Freddie. So my point is that the companies should honor their contracts. If you pay one preferred shareholder, you should pay all preferred shareholders. I'm not arrogant enough to say that I know the exact way in which Fannie Mae or Freddie Mac should proceed in the future with their sponsorship of government. They're a utility in many ways, in the same way, and they should be looked at the way you would look at an electric utility, a gas company, a regulated utility. They should make a reasonable but not excessive return. They shouldn't be used for political purpose. So our only point on Fannie and Freddie is, we're investors. You can decide what you want to do, but when a company goes back to profitability and has paid off their major investor, you have to treat everyone fairly. You can't pick and choose who gets paid, who doesn't get paid. I mean, after all, we're a country of laws, so this is really about the law. But
the courts are moving against, some of these lawsuits have come up, yourself or other investors who have that same point of view about the shares and them honoring this contract. And the courts have said, look, these preferreds were created in 2008. It's the financial crisis, basically a ward of the government. It doesn't seem like it's moving in your favor. And these are huge positions.
Well, it's only just begun. But here's the analogy. Someone comes to you and says, I'm worried about the environment. I'm taking over the mortgage in your home. And here's the deal. You don't have any say in it. I'm just telling you what the deal is. The deal is I own your mortgage. I'm going to charge you 10% per annum. And that's it. You pay me my 10% per annum. You pay it off. We'll talk. And then if everything's going well, you're working, you've recovered, you easily paid back the 10% per annum. In fact, everyone realizes that you didn't even need this special treatment to begin with. You were more than capable of taking care of yourself. Now I'm saying, oh, I don't know. I didn't think you were going to pay back your mortgage, but now you're going to pay back your mortgage, and what am I going to do? I should say, great for you. But instead, I come back and I say, you know what? I'm changing the deal. Oh goodness, there may be a recession or there may be a depression that could last for 20 years, and I don't want to worry about you and your home.
Future, right.
So instead of charging you 10%, I'm just going to take everything you make.
How long can you draw this thing out? I mean, at what point? For years, decades, or do you expect it to come to an end anytime soon here, or?
I think as people understand the situation, and as we're waiting, for example, in the last few days in the Court of Federal Claims, the judge is compelling now, is compelling the government to hand over the documents. There's 11,000 documents that because of national security or some type of privilege, there's a refusal to give the documents to the court. We're just saying, you know what, just show the documents, we'll quickly find out who's right or wrong, and we can move on. So it just takes a long time to do that, but we're getting there. In the Court of Appeals, the DC Court of Appeals, we are waiting for a 3-judge panel to decide whether or not previous decision made was right or wrong. We have not even had a chance to argue anything in court. We've had to spend 3 years in this kabuki dance of stall, and this is the way you have to do it, and judge. And this, it takes time to explain this to the courts, but we really have the law on our side. We have common sense on our side. I think we have business aspects on our side. I mean, after all, these companies. Again, I'm not telling the world what should be done with the companies. I just want our ownership rights to be respected.
Understood.
In the same way you would want your home ownership rights to be respected, or anything else you might own. That's all, and to follow the rules that have been going on for a couple of 100 years. But when you look at the companies, they're the lowest cost producer. They had the best results during the crisis. They helped more people. They were the only 2 companies that kept working during the crisis and lost money on purpose so that the mortgage markets would continue to run. And it was a deal that was set up starting in 1938. So you want to change it, great, but don't change history. Don't rip up contracts. You got to honor your obligations. So that's it. This can be resolved very simply, very quickly. We're just asking for exactly what happened to AIG. The result, today's result in AIG, we want the same. We just want to be treated like every other any other owner of any of the other financial institutions. It's really just as simple as that.
Got it. Let me go back to one of your other positions,
Sure.
big holdings in Sears. Speaking of patience, there was a sense that you wanted to get more activist with this company, maybe shake things up a little bit, or I don't know if activist is quite the right word to use. But what is your relationship like with Eddie Lampert, and how are you positioning?
I have a tremendous amount of respect for Eddie and what he's trying to do. I didn't join the Sears board as an activist. I joined the Sears board to try and help, and to see if I could help for the benefit of all shareholders and for the benefit of Eddie Lampert and the team. Not that they need much of my help. I'd say I've studied Sears for the past decade. I've only been on the board since February. So I could tell you the immense amount of work I've done, that Sears has a huge asset base that is significantly greater than its liabilities.
Because you view this kind of as a real estate play, which it already has turned into, but the company has had to kind of take money from Eddie itself to keep going here. I mean, it's under some significant pressure.
That it is under pressure. I mean, even though the total debt of the company is not increasing, there's been a substitution of the type of financing the companies use from inventory to other ways. And I give him credit for that. He's major owner. He's willing to step up. I'd love to step up more, but I'm limited from the Investment Company Act of 1940. I have limitations on how much I can do. But I wish if I didn't have those limitations, I would be right there with them, even to a larger extent.
Doing what exactly?
Helping the company, whether it's to finance the company, support the company. I mean, eventually people will understand the asset base of the company, but that's not going to really happen until the retail operating losses are diminished. But for example, the company spun off Seritage. Seritage is doing well. People are starting to understand the value of the real estate. And one day, people may realize that Seritage is just a sample of what exists at Sears. Because there's still, in my opinion, 3 times as much in terms of assets that there is at Seritage. And no one really all I hear is that Sears doesn't have any real estate. One day they didn't have any real estate. The next day they had a little bit of real estate. Then next year, oh, that real estate was sold. Now they don't have any real estate. And then 2 years later, it's, oh, yeah, there's some real estate, but now it's really gone. Everything's gone to Seritage. And you'll eventually hear this much more. And they have some great American brands, and the company's announced some strategic initiatives on those brands, and we'll wait to see what happens.
But in the meantime, do you think the consumer trends are turning against the story, just because we've seen a number of department stores suffering from a drop in traffic?
The retail world is upside down.
Yeah.
I mean, but a few years ago, Eddie Lamper was talking about how it doesn't make sense to put all this money into stores. Now everyone's saying that, but a few years ago he was considered to be quite wrong on that basis. Now everyone is going that way.
But do they have a significant online presence to show for themselves while they've been pulling back on the stores?
Yes, that's a great program with Shop Your Way, a membership type program, which is quite good. A few people know about it, but it's my hope that it gains significant traction.
And in the meantime, you're wearing a lot of Land's End gear as well.
I'm wearing all Land's End. Until Sears gets back to $100 a share, I'm just wearing Land's End. I'm still waiting. A couple of my items are on back order, but I'm loving what the new CEO is doing there.
2 final questions for you, which are about the broader landscape. One is especially...
Don't forget St. Joe.
Oh, that's right. That's right. And then we'll get a quick unit on St. Joe, which is a little bit of a local story. I guess that's why it's just. Well, let's talk about that one first for a second. Then St. Joe is a Northwest Panhandle real estate development with a brand new airport that David Einhorn famously bet against, and you are very much in favor of in terms of its long-term prospects.
Right. I have a much longer-term viewpoint than most investors. I like the idea that I could spend 10, 15 years on something and then benefit for 20 or 30 years from the association. I regret not doing this sooner. I mean, the idea of doing something smart, it lasts for a few years, you make some money, and then you have to start all over again, is fine. But in my older age, I like the idea of putting time on my side, making time a friend. So I went into St. Joe. There were obviously issues at St. Joe. I mean, David Einhorn's analysis, he was right in some areas, wrong in other areas, in my opinion. But the company needed help, and to the point where I felt I needed to become the chairman of the company and have a new board and a new management team. So St. Joe's a very exciting situation now. Nothing happens overnight. So my first goal at St. Joe was to give it a fortress balance sheet. So today, St. Joe's net debt free, has hundreds of millions of dollars of cash. A significant component of its market value is just cash. And we have 120,000 of this contiguous acreage of land that entitles us to put up 120,000 homes next to this new international airport. A few days ago, one of our tenants just received a $10.5 billion contract from the Coast Guard to build the next generation Coast Guard cutter. We are actively attracting world-class companies to come and look at this part of Florida, which is truly paradise, low cost, a blank canvas for, that can be configured in any way a company or a family needs. So it's taken a long time to get to a company that is strong, has a very low expense base now. No matter what happens in this world, this company's not going to lose the money it lost in the past, and will be able to take advantage of whatever may come its way. And now we have a new management team in that is bringing in new builders, new manufacturers, because the land is, there's so much of it. We need 2 of everything. We need a Noah's Ark of progress. So we need the shipbuilders, we need the airplane manufacturers, we need the universities, the hospitals, the people.
Talk about being in it for the long term.
The active adult people like myself.
Active senior living.
I can't believe I'm now an active senior, but that's another story.
Let me ask you a couple of quick questions here just to wrap things up. Barry Jerry Sternlicht just said Greenwich, Connecticut is the worst housing market in America and has followed you to Florida. David Tepper's followed you to Florida. What do you think is the worst housing market in America?
I don't know. I think Miami's a great market. I was excited about moving to Miami a decade ago. It worked out better than I thought. Florida's a great state. It's unbelievable to live in a tax-free state. I think it's more about the economics. I think at some point when Uncle Sam becomes greater than your 50-50 partner, something gives, and you got to make a move. And the great thing about the United States, with different states, you can pick and choose which state you want to live in.
Vote with your feet. Yeah.
And that should be a market signal to all states on what needs to be done.
Another related question: come November, are you voting for Donald Trump?
Oh, why did you ask me this? I'm going to be in such trouble with so many of my friends. So here's how I'm looking at it, and I can't believe I'm telling you this. I'm not looking at the candidates. Okay? I'm looking at the people that will be doing the major work for the candidates. Okay? So I'm taking away the personalities of the presidents, and I'm treating them more as they are the cheerleader for the country, PR. But I'm looking at the people who are going to do the hard work for the country in terms of reforming financial systems, welfare benefits. And I have to tell you, when I make that comparison between who's going to be working on this side and who's going to be working on that side for the president, right now I'm picking the people that Donald Trump is picking to do the heavy lifting for the country. And that can change, but I want to see who's going to be in charge of the Treasury. I mean, I've had a lot of difficulty with the last administration. And
so when people say that they want to sell stocks or sell U.S. assets because Trump could win, you're actually doing the opposite. You think that might be a better outcome.
I don't. I give the country much more credit than that. The country is much stronger than that any one president or any one candidate can destroy the country. They can delay us, they could advance us, but we have a system of checks and balances. We have a Congress, we have a judicial system, we have the executive branch. They always don't agree. Some people like the idea that they don't agree. But in terms of some common sense moves that no one's talking about and what I think they will do, there are aspects I like Donald Trump's people, and I think they will be more helpful to the working class. Because at the end of the day, the key, and everybody that's wealthy knows this, that without a vibrant working class, we're all dead. Right? Our children are in trouble. This country is in serious trouble without a vibrant working class, and we have to do whatever it takes to have that vibrant working class. Education systems, the ability to learn the right skills today. So there's a lot to be done, and it's hard to really understand what the candidates are saying, but that is it. And
that's how you evaluate.
And maybe one day we'll talk about indexation.
I was going to say one last question, bringing it back to the markets on exactly that point here. There's been a huge move towards passive investing and index investing, and you represent the kind of old-style active management way of doing things.
Right.
Where is this going? Are people making a mistake by throwing their eggs now in the indexing basket? How can you argue, especially given the last couple of years, for active management?
The last couple of years have been tough, but it's a little ridiculous to think that any person's not going to have a rough couple of years. Charlie Munger had a rough couple of years. Warren Buffett had a rough couple of years. History shows you're going to have a rough couple of years, the probabilities. So that's just part of the process, that you're going to have, people are going to disagree with you for at times a long period of time, sometimes longer than you wish. And you're going to look wrong until you're right.
Until you look like a genius.
Right. But with indexation, when you think about it, it's generally a good idea. So the idea is that an index represents the country. As the country grows, the index grows. You do well. It's low cost. It's low friction. And that should work, and that should work for most people. But it still assumes a bunch of things. It assumes that the index investor has long-term patience. It's not going to be spooked. It assumes that when you buy the index, that it's fairly valued, there isn't an extreme valuation that you know, when you bought the index and before the technology crash, late 90s, early 2000s, it took you 12 plus years to recover from an index because the technology was so heavily weighted in the index. And so that's another issue you have to watch out for, and it also assumes a more normal interest rate environment. So as interest rates eventually go up, when, who knows, I thought this would have happened 5 years ago, so again, my timing is less than perfect. But it's a gravitational pull on all assets. So as we started the conversation about banks and how banks may have, you know, that interest rate increase will be less of a pull on the banks because it will be helpful to them on their margins. I think it is helpful, you know, to be not correlated with the index because the index will be affected in general by interest rates. I think you'd be better off trying to find or invest in companies if you can that will be less affected by rising interest rates and less affected by the movements in the index. Because after all, if everybody, it's the usual, it happens, like good ideas are taken to an illogical extreme. Home ownership is great, but it went to home ownership is great for everyone, even if you don't have a living. And this is indexation is great, but it's going to get to this illogical extreme where people are going to say, I don't have any fiduciary responsibility by investing in an index. It's going to be the average. Everyone's going to be affected the same way.
Right.
It doesn't matter that maybe I don't know too much about the 500 companies within the index, and I just have to, you know, keep my fingers crossed. It's a sort of dumbed down, easy way that should work most of the time, but you know will badly fail at some point.
That's a good place as any to leave it. Thank you again, Bruce Berkowitz, for joining me. Thank you.